Evening. Welcome to Economics 330, Global Trade and Political Economy, City University of New York, Medgar Evers College. Today is Tuesday, October 29th, 2024. And this begins the formal section of today's office hour and lecture. As you should know at least, in the past three classes, correcting, of course, for the 2 weeks that were set aside for our term paper. We have completed a three-part study of the three theoretical perspectives of global trade. That really comes off like a tongue twister, but it's not, or at least that's not the intent. So those three perspectives are the liberal perspective, the realistic perspective, and the historical materialism. Of course, the liberals believe in international institutions, a rules-based international order. The realists believe that those international institutions are okay as long as they serve a national interest. Of course, others, the historical materialism, think that there are inbuilt, baked-in imbalances in the global trade. There is a client-patron relationship, and there is a core and periphery country divide, or a global north or global south country divide, and there is a client-patron relationship with the elite in the developing country world being in cahoots with the multinational corporations. Just brief overview of our last three classes. So this week, we will begin a new three-part study of international trade and their components. And these include international monetary relations, global trade relations, and three, regional trade agreements. International trade activities are driven by resource transfer, i.e., money. That's really the whole point, right? Folks want goods and services at the most efficient price. And therefore, concepts that we've covered previously, such as comparative advantage, begins to come into play. Mediating in international institutions such as the World Trade Organization come into play. So therefore, one must understand the nature of the international monetary system in order to appreciate global trade relations. So you really, if the whole idea is about money, then it's important to interrogate the international monetary system. In a three-part, 3-week study that begins this week, or began this week since today is Tuesday, and the week started on Monday, we will address how nations relate to each other in the process of trade. For example, a country can limit the exportation of certain goods, or trade could be encouraged freely by one country, but limited by another. We will also address the question, what are the reasons for tensions and conflicting differences in policies? So why is it that one country has a policy of free trade and another country would have a different policy of perhaps imposing tariffs? One way of resolving conflicts will be to negotiate cooperation between neighbors and sometimes group of nations. So this cooperation, an example, of course, will be the US-Mexico-Canada agreement, which many of you, some of you wrote about regional trade organizations in your term paper. So I am really, really proud that that happened. Since this course is based on global trade and political economy, we will discuss the mechanics of money and trade. So first, we begin with balance of payments. We will discuss how monetary flows affect the ability of a nation to transact international business with others. As an example, if a nation is unable to trade due to monetary limitations or imbalances that may be temporary, These may pose problems when they seek arrangements to help them address the temporary problems. These may lead to long-standing or lingering instability to participate in global trade. Addressing this challenge through bilateral arrangements rather than institutional arrangements may lead to political control of one country by another, which in turn could create international political issues within and between countries. So let me really unpack what that really means in real life. So if a country is unable to sell enough stuff to earn foreign exchange so that it can buy stuff that it doesn't make and needs, that's called the balance of payment or balance of trade, right? Your balance of trade is the surplus over what you've sold to others and what you want to buy from others. So if a country doesn't sell enough goods, let's say a country sells 500,000 worth of goods and services, but it needs to import $1 million worth of goods and services. Hang on one second. This is interesting. This has never happened before, and I'm glad I caught it. I have to do this. My notebook nearly fell. So if a country sells $500,000 worth of goods and services, but it needs to import $1 million worth of goods and services over the same period, it really has two choices. It could negotiate a bilateral arrangement, which means between that country that doesn't have the money and another country that is willing to loan it the money. The problem, of course, is that you can see how the country borrowing the money can quickly become a client state, because you have to imagine that the one loaning the money would want some security, collateral, or some assurances, one way or the other. And quickly, the country doing the borrowing could begin to lose some of its sovereign authority. Alternatively, that country that needs to borrow money can go to a multilateral lending organization where no one country would have leverage over it. And this is where, for instance, the IMF comes in. Now, so let us begin with a brief overview of the evolution and history of international monetary relations, because we just did not arrive at the IMF. As many of you will recall, the IMF is part of the Bretton Woods institutions that came about post-World War II. Historically, gold has been used as the reference point for currencies. The system of tying currency value to gold functioned quite well until the mid-20th century. The gold standard, I'm sure some of you may have heard of that, hopefully all have had of the gold standard. The gold standard system in the early 1900s pegged the value of gold at $35, US dollars that is, per ounce of gold, which was the reference point other nations used in fixing the value of their currencies. It is important to note that this price was not the commodity price of gold. In other words, this $35 per ounce of gold, that 35 US dollars, we have to emphasize that because this is, of course, an international class. And we have Canadian dollar, we have New Zealand dollar, we have Australian dollars, and many other dollars. But the gold standard of dollar is the USD. But anyways, it's important to note that during this time, the $35 per ounce of gold was not the commodity price. So if you were a private business, you couldn't go out there in the market and buy gold at $35 per ounce. This was a discounted rate that was only open to governments. So indeed, private investors could not purchase gold at this price point. Government had exclusive right over private individuals to buy gold at this below market price, thus reducing the volatility of currency values. However, in 1944, the US government pursued an expansionary monetary policy in a bid to financially support World War II efforts. Please note that expansionary monetary policy involves a reduction in taxes and an increase in government spending. Both measures are meant to stimulate the economy and increase the level of activity within the economy. So if the government wants to, remember, recession led right into the World War II, right? And then at the peak of towards the end of the World War II, the government was still looking for ways to stimulate economic activity and pull the country out of recession. One of the things that it did was reduce taxes, right? And increase government spending. That can potentially create problems for government. Although Keynesian economists would say that that's what you're supposed to do. That governments are supposed to build economic buffers, financial buffers. That way, during times of economic downturn, the government can spend its way into increased economic activity. But notice that this also happens at a time that the government knows it's going to lose revenue. That will be the equivalent of an individual spending more money even as they're taking a pay cut. But for an economy and at a macroeconomic level, this policy caused inflation to rise and resulted in the US dollar losing value fairly quickly. If everybody has more money than they used to have, they're going to start spending more, all things being equal. If you are a retailer and 20 people want to buy a widget, and a widget is an economic term for whatever it is that someone is selling, it could be anything. If you're a retailer and you realize that 20 people want to buy your widget and that you only have 10 widgets and there ain't too many other widgets in town, but there's so much money chasing the widget that you want, what do? You increase the price. Perhaps before you even increase the price, one of your customers may say, hey, don't sell it to them. I'll pay you double if you will give me the widget. I just say this to illustrate how too much money in the system that is not backed by economic activity can quickly create an inflationary pressure. Eventually, the practice became quite unsustainable. The practice, of course, of reducing taxes and increasing government spending due to placing unrealistic demands on the inflation of the US dollar. In 1944, as a result, the gold standard was abolished and replaced by pegged exchange rate regime. Now that we have established a foundational overview, let us then transition to this week's learning objectives. The first will be to explain the term balance of payments. I got a little bit ahead of myself there. Or how this concept affects the ability of a country to participate in global trade. The balance of payment, or BOP, also known as the balance of international payment, is the difference in total value between payments into and out of a country over a period of time. Put differently, BOP is the method by which countries measure all of the international monetary transactions within a certain period. The BOP consists of three main accounts: the current account, the capital account, and the financial account. Note that the current account is meant to balance against the sum of the financial and capital accounts, but rarely does. The balance of payments transactions consist of imports and exports of goods, services, and capital, as well as the transfer payments such as foreign aid and remittances. A country's balance of payment and its net international investment position together constitute its international account. Globalization in the late 20th century led to BOP liberalization in many emerging markets. Developing countries lifted restrictions on BOP accounts to take advantage of cash flows arriving from developed foreign investors, which in turn boosted their economy. In other words, you don't want to restrict the thinking then, economic thinking then became that you don't want to restrict foreign capital inflows into your economy as investors begin to chase profits and begin to chase new investment opportunities. And as the rise of multinationals began to reemerge, and multinational companies began to look for new places to invest and supply and source their inventory. So the second learning objective is to describe the International Monetary Fund and how it facilitates world trade. This is really important stuff. The International Monetary Fund, founded in 1944, is a voluntary financial institution with a membership of 184 countries. It fosters among these countries cooperative monetary policies that stabilize the exchange of one national currency for the other. It thereby encourages international trade. This is important because if country A uses shillings and country B uses pounds, and they want to buy products that are valuated in US dollars, there has to be some rationality to the markets where each player in the marketplace has an understanding of the rationale behind the valuation of each currency and the evaluation of the underlying product or service that they're looking to consume. The IMF, therefore, provides a mechanism in which each member country can cooperate with the others to promote its domestic economic prosperity and that of the entire membership. The IMF maintains an extensive database of statistics on members' economies and on the world economy as a whole, which it shares with every member country. At the request of a member, it extends technical assistance in financial, fiscal, and economic matters. And this next point is crucial. If persuaded that a member country is behind in payments to other countries, IMF will implement reform policies. The IMF will lend money to tide that member over until the reforms take effect. Lastly, the purposes of the IMF are clearly expressed in Article 1 of its constitution. The Article of Agreements includes, first, to promote international monetary cooperation through a permanent institution which provides the machinery for consultation and collaboration on international monetary problems. Second, to facilitate the expansion and balanced growth of international trade and to contribute thereby to the promotion and maintenance of high levels of employment and real income, and to development of the productive resources of all members as primary objectives of economic policy. Third, to promote exchange stability, to maintain orderly exchange of arrangements among members, and to avoid competitive exchange depreciation. Very quickly, what competitive exchange depreciation means is a race to the bottom, where one country thinks, gee, if I'm going to try to gain a market, I know I sell flip-flops and this other country sells flip-flops too. But if I really try to corner the global market for flip-flops, maybe I can reduce my price. And then more people will buy from me. But once you do that, the other country will say, gee, I have to reduce my price even lower so I can regain market share. You can see how that depreciating your currency would lead to a race to the bottom, because eventually you will not have the profit margins in the products and services that you sell, which defeats the whole purpose. Because again, the whole point of international trade is to make money as you provide goods and services that others want to consume. So the third point is to promote exchange rate stability, to maintain orderly exchange arrangements, among others, and to avoid competitive exchange depreciation. Fourth, to assist in the establishment of multilateral systems of payments in respect of current transactions between members and in the elimination of foreign exchange restrictions, which hamper the growth of world trade. Fifth, to give confidence to members by making the general resource of the fund temporarily available to them under adequate safeguards, thus providing them with the opportunity to correct maladjustments in their balance of payments without resorting to measures destructive of national or international prosperity. And sixth, in accordance with the above, to shorten the duration and lessen the degree of disequilibrium in the international balance of payment of members. Again, equilibrium obviously is that balance where your cash outflow and cash inflow are at an optimal level. When your cash outflow exceeds by a great margin your cash inflow, you are at a disequilibrium, and that is an economic term in this case. So sixth is a degree of disequilibrium in the international balance of payments. So the third learning objective is to explain how exchange rates are used to manage trade by individual nations. So it is helpful to begin by differentiating between exchange rates. So the first type of exchange rate is the floating exchange rate. The second type is the fixed exchange rate. And the third is the pegged exchange rate. So let's unpack these and see how they are distinct, dissimilar, or not very distinct from each other. So advantages of a floating exchange rate is that it can be traded without any restrictions, unlike currencies with fixed exchange rates. Hence, governments and banks do not need to resort to a continuous management process. Some of us who have been to the Caribbean, from the Caribbean, have roots in the Caribbean, know that we have friends, relatives, cousins who live in the Caribbean but sometimes have difficulty buying as much US dollars as they want. This is because they don't have a free floating exchange rate, and I will come to why that is. Floating exchange rates enhance the efficiency of markets, especially as a country's macroeconomic fundamentals affect the floating exchange rate in global markets, influencing the flow of portfolios between countries. In floating exchange rates, central banks are not required to keep large foreign currency reserve amounts for defending the exchange rate. Hence, their reserves can be utilized for promoting economic growth by importing capital goods. Now, here are the disadvantages of floating exchange rates. So one disadvantage of floating exchange rates is that are prone to fluctuations and high volatility by nature. A currency value against another currency may deteriorate only in one trading day. This is because the market in a floating exchange rate gets to determine the value of the currency, not the central bank of the country. The lack of control over exchange rates can limit economic growth or recovery. The negative currency exchange rate movement may lead to serious issues. For example, if the dollar rises against the euro, it may be more difficult to export to the Eurozone from the US because goods, if the dollar rises too much in value relative to the euro, goods that are, all things being equal, goods that are manufactured in the United States will become that much more expensive for Europeans. Therefore, those European consumers may begin to look for alternate products or substitute products from other regions. If a country is suffering from economic issues such as unemployment or high inflation, floating exchange rates may intensify the existing problems. For example, depreciation of a country's currency already suffering from high inflation will cause inflation to increase further due to an increase in demand for goods. Moreover, expensive imports may worsen the country's current account. On the other hand, a fixed exchange rate, also known as the gold standard, that goes that phrase again, quantifies the values of currencies by using a stable reference point. Historically, gold has been used as this reference point. This is because it is a valuable commodity worldwide, and its value is less susceptible to fluctuations in interest rates, the value of gold, that is. Then, a pegged exchange rate regime system incorporates aspects of floating and fixed exchange rate. Smaller economies that are particularly susceptible to currency fluctuations will peg their currency to a single major currency or a basket of currencies. These currencies are chosen based on which country the smaller economy experiences a lot of trade activity with, or which currency the nation's debt is denominated in. Lastly, it is helpful to note that countries should have a macroeconomic growth strategy, a theory of growth. These may include a combination of A, an import-led economy, B, a domestic consumption-led economy, or C, an export-led economy. Now, a few things to unpack here very quickly. So I did say that smaller economies that are particularly susceptible to currency fluctuations may peg their currencies to a country or to a basket of currencies from many countries. This is important to know. For instance, China actually pegs its currency, the renminbi, to a basket of currencies that includes the US dollar, the British pound, the euro, and I think the Japanese yen. Part of the argument against China is that this pegging to a basket of currencies is geared towards keeping the value of the Chinese currency artificially lower than these currencies from these other countries, so that goods manufactured and sold from China would always enjoy a competitive advantage. On the other hand, if you're a small country and you're taking a lot of loan facilities in the US dollar, as one example, and you are investing in, say, transportation infrastructure. Of course, when you build a rail line in country X, the revenue from that rail line will come in your local currency because people in your country are not going to buy it. They're not going to go buy a train ticket with US dollars. They're going to buy it in your local currency. And presumably, you're going to want to retire that loan that you took to build that rail line from the returns you make from operating the rail line. It becomes necessary then for you to be able to project the break-even price of that loan. You want to have some certainty on what the value of your local currency is relative to the dollar. You might want to say, well, our currency is 50 cents to the US dollars. It's one of our currency to 50 cents. So I now know that I would have to sell the ticket at $2 to equal $1. And then I can project how much tickets I need to sell to be able to service that loan without defaulting. But for this to happen, there has to be stability between the value of your currency and the US dollar, which is one reason why a smaller country will peg its currency to that of a major creditor or potential creditor country. Pegging doesn't have to mean that it's 1 for 1. Doesn't mean that one of your currency is equal to $1. It could be 2 to 1, 3 to 1, 5 to 1, 10 to 1, 20 to 1. But at least there is predictability and there is stability. So that is the point of a pegged exchange rate regime. And with that, we conclude our formal lecture this evening, and we will transition into Q&A. But before we go, please note that next week's lecture will be on global trade relations. So we're getting to the meat and potatoes of the class. Thank you very much. And now I will turn off the recording so we get into the Q&A. Thank you.